Listen carefully, because what I'm about to tell you could completely change your understanding of what's happening with Ethereum and your investments right now. At the end of December 2025, everyone was saying the same thing. On Twitter, in Telegram, on forums, the same story everywhere. Ethereum is falling, the market is in panic, everyone is selling, we need to get out. The price was bouncing between 2,930 and 2,950, like it was confused, like no one knew which direction to go next. Retail investors, regular people, were selling at a loss because they were afraid of further decline. But here's what's absolutely shocking. While everyone else was panicking and selling, the real whales, large institutional investors, were doing the exact opposite. They were buying Ethereum so aggressively, like never before in history. And this isn't just a passing trend. This is a historic, fundamental shift in how the world sees cryptocurrency and, most importantly, how the world sees Ethereum. Today, I'm going to show you 3 shocking pieces of evidence for why 2026 will be a turning point year for Ethereum. I'll tell you about 3 types of players who are currently buying Ethereum, about the sums that will amaze you, and why all of this together creates a completely unique situation in the market. If you're investing in cryptocurrency or thinking about doing it, this video is a must-watch. You can even watch it several times. Let's begin. The corporate whale, Bitmine. The first player in this story isn't just a company, it's a corporate monster with ambitions that go far beyond ordinary investing. We're talking about Bitmine Immersion Technologies, or as everyone calls it, BMR. Let's start with one specific event that happened on December 29th, 2025. It was right in the middle of market panic. People were selling their Ethereum because of year-end tax deductions. The news backdrop was grim. Analysts were talking about a correction. And at this moment of absolute uncertainty, Bitmine makes one deal. They buy 44,463 Ethereum. Stop. Let's understand the scale. 44,463 Ethereum for $130 million in a single purchase. Imagine this. It's like if one company spent $130 million in a single day on just one stock. This isn't ordinary investing. This is strategic accumulation. But that was just the beginning. When we add up all their purchases, the picture becomes even more impressive. Bitmine now has 4,110,525 Ethereum, 4,110,000 Ethereum. That's approximately $12 billion at current prices. Now let's understand what this means on a global scale. All Ethereum on the planet is approximately 120 million coins. Bitmine controls 3.41% of all Ethereum that exists on Earth. Feel that? If Ethereum were a country, Bitmine would be a major corporation controlling an entire region. This isn't a small holding. This is serious strategic control over an asset. Now the question, why are they doing this? Why, at a moment of panic, when all other smart money is sitting on the sidelines, is Bitmine acting like a madman and buying everything? The answer is direct and honest. Their leader, Tom Lee, said this in an open interview. He looks at December, at year-end, and sees 3 things. First, people panic and sell. Second, companies and hedge funds de-risk their portfolios before the new year. It's standard practice. Third, there's a phenomenon called tax loss harvesting. People sell losing positions to reduce taxes. And in this chaos, when supply increases and demand falls, the price of Ethereum drops. For Bitmine, this is the perfect window. They see this as a one-time chance to buy a quality asset cheaper. But here's the key. This isn't just speculation. They have a clear, stated goal. They want to accumulate 5% of all Ethereum on the planet. That's not a random number. 5% is the magic control number. It becomes too big to ignore. It makes you a serious player in the ecosystem. And here's where it gets really interesting. They're not just buying and holding Ethereum as a speculative asset, waiting for the price to go up. No, they're taking their Ethereum and making it work. They launched a program called staking. If you're not familiar, it's simple. You give your Ethereum to a special network program, and you get interest, just like you'd get if you deposited money in a bank. A bank pays you 5% a year for giving it your money. It's the same here. Bitmine already has 48,000 ETH locked in staking. That's approximately $1.2 billion. And every day, every month, these 48,000 ETH generate additional income. This isn't passive income. It's active daily money making on an asset they already own. But that's not all. In Q1 2026, that means January, February, or March of next year, Bitmine plans to launch its own validator network called Mevan Network, Made in America Validator Network. What does this mean in simple terms? It means they're becoming not just a holder of Ethereum, but a builder of infrastructure. They literally become part of the system that processes all Ethereum transactions. It's like if you didn't just own shares in a railroad, but you started running the station yourself. You're no longer an investor. You're a participant in the system. This fundamentally changes the dynamic. When you have such a massive holding and you're building infrastructure on top of it, you gain enormous influence over the development and direction of the entire system. Context: the real-world assets market. To understand why Bitmine is so confident in Ethereum, you need to understand one big trend that's happening right now in the financial world. In 2025, the financial world discovered something new. Major companies, governments, and investors started tokenizing their assets. What does that mean? It means they take real assets. For example, government bonds. These are government IOUs, corporate bonds, real estate, precious metals, and gold, and create digital twins of them on the blockchain. Why is this needed? Because it allows these assets to be traded faster, more safely, and cheaper. You can complete a deal not in a day, but in minutes. You can lock in a deal without intermediaries. In 2025, this tokenized real-world assets market, real-world assets, RWA, reached a size of 30 to 33 billion. That's not small money. That's serious money from major financial institutions. And here's what's most important. 60% of all these assets are hosted on Ethereum. 60%! That means Ethereum is the primary platform on which this system operates. JP Morgan uses Ethereum. BlackRock uses Ethereum. Governments use Ethereum. Bitmine sees this. They understand that Ethereum is becoming the infrastructure of the global financial system. It's not a coin. It's not a speculative asset. It's a necessity. It's like the electrical grid. Without it, the economy can't function. That's why they're buying Ethereum, because they see a future where Ethereum is the base layer for the global financial system, and they want to be a major player in that system. The risky strategy: trend research. The second player in this story is even more aggressive, maybe even crazy. But his craziness shows a level of confidence in Ethereum that's simply shocking. It's a private firm from Hong Kong connected to the investment fund LD Capital. The founder of LD Capital is a man named Jack Yai. The company isn't as well known as Bitmine, but what they're doing is much more aggressive and risky. They've bought 626,000 Ethereum. That's approximately $1.8 billion, the second largest holding among private firms that we know of. But the most interesting thing isn't how they bought it, but how they financed it, because they clearly didn't have $1.8 billion in cash. So they used a super complex, super risky financial trick called OV looping, named after the Aave platform. It sounds like a name from a sci-fi movie, but let's break down what this is in simple terms. How OV looping works. Financial leverage. Imagine you have $1,000 in cash and you want to invest more than $1,000. Step 1. You take your $1,000 and give it to a lending platform. It's like a bank for cryptocurrency. You say, here's my $1,000, it's yours. I'm giving it to you as collateral. Step 2. The platform looks at your collateral and says, okay, you have $1,000 in collateral. I'll give you $700 in cash as a loan. That's 70% of your collateral value. Step 3. You take that $700 loan and go to an exchange, like Binance, and buy more Ethereum with $700. Step 4. You take this new Ethereum and give it to the same platform as new collateral. Step 5. The platform looks again and says, okay, you have another $700 in collateral, I'll give you another $490 as a loan. Step 6. You take that $490, go to the exchange, buy more Ethereum. Step 7. And you repeat this again and again and again. Essentially, you create a loop where each time you take more debt to buy more Ethereum, which becomes collateral for the next loan. It's like a spiral that keeps twisting upward. Trend Research did this at scale. They borrowed approximately $958 million to $1 billion through this system to buy additional Ethereum beyond what they already had. But here's the danger, and this is critically important to understand. When you use leverage like this, you're dependent on price. If the price of Ethereum starts to fall, your collateral loses value. And when the collateral loses too much value, the system automatically, without your permission, starts selling your collateral to pay back the debt. For Trend Research, this critical price is $3,265. That's their average purchase price. If Ethereum falls below this price, the system will start automatically liquidating, selling, all their collateral. Right now, Ethereum is trading below this price. That means they have significant unrealized losses. If the system liquidates their position, they'll lose huge amounts of money. And you know what's most shocking? They know about this. They see these numbers every day. They see that their position is underwater, losing money, and they keep holding. They keep taking risks. What does this say about their faith in Ethereum? It says they believe in the 2026 super cycle so strongly that they're willing to lose billions if they're wrong. They literally bet their entire company on this. This isn't investing. This is religious faith in Ethereum's future. Traditional finance enters. The third level is what truly frightens and inspires the traditional financial system. This is when big, legitimate, regulated financial companies start entering. We're talking about BlackRock and their ETF, exchange-traded fund, called ETHA, Grayscale Ethereum Trust. What is an ETF? It's simply a stock that you can buy like a regular stock on a stock exchange, but instead of owning a piece of a company, you own a piece of an asset, in this case, a piece of Ethereum. Why is this important? Because it gives proper companies, banks, and investment funds the ability to buy Ethereum legally, safely, and without having to deal with the technical side of things, like storing private keys and such. BlackRock launched ETHA in mid-2024, and its popularity just exploded. According to our sources, by late December, 510 established institutional investors owned shares of this ETF. 510, that's not dozens, that's hundreds of major organizations. And let's look at the names. Goldman Sachs, one of the world's largest investment banks. Citadel, one of the world's largest hedge funds. Jane Street, a mega-powerful trading firm. Susquehanna, another giant in trading. Millennium Management, a huge multi-strategy fund. These aren't small players. These are the engines of Wall Street. These are the financial elite of the planet. Together, they own 27.6 million shares of this ETF, which means control over a huge amount of real Ethereum on-chain. But why don't they just buy Ethereum directly? Why use an ETF? Simple answer, it's complicated, risky, and requires special equipment. If you're a regular investor and want to buy Ethereum, you go to Coinbase or Kraken, create an account, and buy. Simple. But if you're Goldman Sachs with trillions of dollars under management, you have problems. Security. Where will you store your Ethereum keys? In a safe? On a computer? That's responsibility on a massive scale. Regulation. Different countries have different rules. If you're an American bank buying crypto on an American exchange, what taxes? What reports? Speed. If you need to quickly redistribute assets between portfolios, working with Ethereum directly is slower than working with ETF shares on a regular exchange. So, an ETF is the perfect solution. It's just a stock. It can be bought, sold, pledged, used in complex financial instruments in seconds. But here's what's critically important to understand. When Goldman Sachs buys shares of this ETF, BlackRock has to go out and buy real Ethereum somewhere on the market to back these shares. This isn't virtual. This is real demand for real Ethereum. Over 2025, approximately $9 to $10 billion passed through the ETF in the form of investments. This is guaranteed, legal, regulated demand for Ethereum. And what about the selling we saw in December? Yes, there was some selling, but it's not panic. It's a financial trick called tax loss harvesting. Here's how it works. Say a company bought Ethereum for $3,500, but now it's trading at $2,950. It has a paper loss of $550. At year end, the company can say, okay, I'll sell this position to lock in the loss. With this loss, I can reduce my taxes on profits from other investments. This is just financial planning. It doesn't mean the company lost faith in Ethereum. It's just math and tax optimization. And in a month or two, when tax season ends, they buy Ethereum back. The full picture and analysis. Let's put all three components together and look at the complete picture. Component 1. Bitmine buys physical Ethereum, locks it in staking, and will soon launch its own network infrastructure. This is long-term strategic accumulation. Component 2. Trend research uses financial leverage and risks enormous sums to buy even more Ethereum. This is short-term, aggressive accumulation with maximum risk. Component 3. BlackRock and traditional finance enters through ETFs and other legal channels. This is slow, stable, regulated accumulation. Together, these three components create a perfect storm for Ethereum. Why is this so significant? Because when you combine these three forces, you get one main thing: supply reduction. Imagine an apple market in a city. There are 100,000 apples total. 50,000 apples are sold each day. The price is stable. But then 3 major companies show up. The first company, Bitmine, comes and buys 30,000 apples. It doesn't sell them. It stores them and uses them to make apple juice that it sells. Apples from its storage aren't sold on the market anymore. The second company, Trend Research, borrows money and buys another 10,000 apples. It stores them too, waiting for the price to rise. The third company, BlackRock, buys another 20,000 apples through its ETF and keeps them in a warehouse. Now there are only 100,000, 30,000, 10,000, 20,000, or 40,000 apples in circulation. But demand for apples stays the same or even grows because new people are coming who see the ETF's popularity and want to buy too. Demand, 50,000 apples. Supply, 40,000 apples. Shortage, 10,000 apples. What happens? The price shoots up. Economics 101. This is what's happening with Ethereum right now. The second component, infrastructure shift. But that's not all. There's one more critically important thing. Ethereum is no longer seen as a coin of the internet or a speculative asset to make quick money on. Ethereum is seen as the infrastructure for the global financial system. This is a fundamental shift in perception. When JP Morgan launches tokenized bonds on Ethereum, that's not speculation. That's choosing an infrastructure. When governments start developing digital currencies that will run on a blockchain similar to Ethereum, that's not speculation. That's a strategic decision. When BlackRock launches an ETF and brings in $9 to $10 billion a year, that's not speculation. That's legal regulated adoption of a new asset class. When all these things come together, you don't just get a price increase. You get a fundamental reassessment of what Ethereum is and why it matters. Forecast and practical conclusions. When analysts talk about a supercycle in 2026, they don't mean just another wave of a 20-30% price increase. They mean a move to a new paradigm where Ethereum trades above $4,000 because it's becoming a necessity, not speculation. Why $4,000? Because at that level, more functionality can run on Ethereum. At that level, building infrastructure on Ethereum becomes more economically viable for companies. At that level, potentially even larger institutional investments will begin. Now, if you're an investor in BMR stock, remember, BMR is essentially a company that owns Ethereum and a little management structure on top. $13.2 billion in assets is almost entirely Ethereum. More precisely, $12 billion out of $13.2 billion. That means if Ethereum goes up 20%, BMR should also go up 20%, minus a small discount for management expenses. But there's an additional factor. In the stock market, there's a phenomenon called NAV premium, net asset value. When a company trades above its net asset value, it means the market believes in the management and the company's future. If BMR starts trading at a premium, say, instead of trading at parity with NAV, it trades 10-15% above NAV. That adds another 10-15% to shareholder returns. Plus, there's the catalyst of Q1 2026, the launch of Bitmine's own network infrastructure, Mevan. This event could be a trigger for the company's revaluation. Now, if Ethereum goes up 30%, which is quite realistic in a supercycle, and BMR gets a 15% premium, then shareholders see potential gains of 50 to 60%. This isn't a guarantee. This is a scenario assuming macroeconomics cooperates, no new crypto ban, no global financial crisis, etc. But the numbers here are very compelling. Final perspective. Listen, I'm telling you all this not because I'm bullish on crypto. I'm telling you this because I'm looking at the facts. Fact: the biggest money in the world is buying Ethereum. Fact: they're doing it when the price is weak. Fact: they're doing it with a level of confidence that borders on fanaticism. Fact: they're building infrastructure on this asset. Fact: Ethereum has become the primary platform for a new asset class, RWA, worth tens of billions. This isn't a conspiracy. This isn't a rumor. This is public data, blockchain readings, and official company statements. The main question every serious investor is asking right now: how much Ethereum needs to be permanently frozen in staking and in RWA applications before we see real exponential shortage that forces the price to jump 200 to 300%? This is what could turn an ordinary price rise into a historic celebration for investors. And in 2026, we might just get the answer. Call to action and outro. If you watch this video to the end, thank you. That means you take your investments seriously and want to understand what's really happening in the market, not just follow emotions. Here's what I ask you to do. First, like this video. Not because you agree with everything I said, but because it helps YouTube's algorithm show this video to more people who need to hear this information. Second, subscribe to the channel, because in the next video, I'll dive deeper into the analysis, which other companies and funds haven't yet entered Ethereum, and when the next wave of institutional buying is likely to happen. Third, turn on notifications, because when I upload the next video, it could be within a week or a few days. I want you to be among the first to know. And if you have questions or want to share your perspective, comment below. I read them, and I often respond. Thank you for watching. Let's meet again in the next video. Good luck with your investments.